Good afternoon, Professor Farrell, and everyone else who's watching at home. Today we'll be speaking to you guys about financial liabilities. So just a quick agenda and overview we'll be going through. We're going to talk about IFRS, the financial liability accounting policy. Then we're going to go through some financial statement presentation of how it's shown on the financial statement for IFRS. We're going to talk about disclosure policy relating to IFRS. Then we're going to go into different companies that we selected, which are 4 of them. Then we'll talk about similarities and differences between each of the companies and how they present financial liabilities on their annual report. And we're going to go through financial restatement of showing with ACTG. So moving along, what is a financial liability? Financial liability is an instrument that gives rise to a liability of one party and an asset of another. So what does this mean? According to IAS 39, it's a contractual obligation to deliver cash or another financial asset to an entity, to exchange financial assets or financial liabilities with another entity under conditions that potentially are unfavorable to the entity. Or also it could be a contract that will be settled in an entity's own equity instrument. So let's give an example of financial liability. An example would be an account receivable to one party, or it would be an account payable to another. So what are some categories of financial liability? Well, the main one is other financial liabilities. So what is this? It's the most financial liabilities, which is like the catch-all for everything. So everything falls into this category, and whatever doesn't fall into this category goes into the next classification, which I'll talk about in a little bit. The initial valuation, so it's valued at fair value, which is the transaction value, and then you capitalize all transaction costs to the liability, and then the subsequent valuation would be cost or amortized cost, and this is under IFRS. The next classification would be through fair value through profit and loss. So anything that doesn't classify as other financial liability will then fall into this category. So why would it fall into through fair value through profit and loss? Well, the liability will be sold in the short term, or also it can be a management decision. So what's the initial valuation? So it's initially valued at transaction value, and any costs are not capitalized. Instead they're expected, which is the difference between the first classification. The subsequent valuation would be all of the fair value changes go through gains and losses in the statement of profit and loss. So what are other financial liabilities? Since this is the main category for a lot of public companies, let's look further into it. So like I said, they're initially valued at fair value. Other considerations received, plus the transaction costs, they're capitalized, and then they're carried at this value, which is the cost or amortized cost, over their useful life. So for example, when a company receives an invoice for a fair value of a good shipped by a supplier, the goods are the consideration, and their invoice price is the liability. For all categories of liability, they must be discounted in value as the present value cash flow, where the discount rate is the current market interest rate. Once liabilities are discounted, the interest expense on the discounted liability is recorded as time passed. So some examples of other financial liabilities, the accounts payable, where you get into an agreement with a supplier. If you buy your goods on credit, this sets up an accounts payable on your balance sheet. Also, it's a notes payable. It's almost like a promissory note, a written promise to pay a specified amount at a specified future date, which is also often a result of a borrowing from a lender. There's also loan guarantees, which is a liability that requires the debtor to pay a loan, principal, and interest if the borrower defaults. And also there's deposits, where these are advance payments for clients. They're recorded as current or long-term liability, depending on the time frame. Now there's another issue that arises in the classification of financial liability. There are different financial liabilities that can be also considered equity. For example, a convertible bond or convertible debt. So the only time it's considered an equity instrument if the instrument includes no contractual obligation of the entity to deliver cash or other financial assets to the party receiving the loan. So if the instrument will or may be settled by the issuer's own equity instrument through a non-derivative that does not have contractual obligation for an issuer to deliver a variable number on its own equity instrument. So what's an example of this? It would be a convertible debt. Convertible debt can be considered as all debt, can be considered as all equity, or it can be a compound instrument, which means that it's both debt and equity.
As you can see here, we have provided an example of a financial liability. In this example, Ferrell Corporation has borrowed $200,000 from Big Bang. It has a 2-year term with 3% interest payable annually, and the principal due on April 2017. The stated and market interest rates in this case are equal, which means that the present value of the bond is equal to the face value. And so you can see here the journal entries with interest expense of $6,000 annually, representing 3% on $200,000. The derecognition of a financial liability occurs when it is extinguished, which is when the obligation specified expires or cancels. When there has been a substantial modification of the terms of a financial liability, the transaction is recorded as an extinguishment, and the recognition of a new financial liability occurs. The gain or loss from this derecognition is accounted for in the statement of profit or loss. And next, with the financial statement presentation. A financial liability to an entity will be shown in the statement of financial position as either a current or non-current liability, depending on the length of the obligation. Changes in fair value of the financial liability translates to the statement of profit and loss. Amortized cost using the effective interest rate method shows the effect of the interest expense on the income statement. A financial asset and liability can be offset, which allows the net amount to be presented in the financial statement, and this can only occur in two situations, either when an entity currently has a legal enforceable right to set off the recognized amount, or the entity intends to settle on a net basis or to realize the asset and settle the liability simultaneously. And now we have disclosure. The carrying amount of financial instruments in each category and the appropriate fair value must be disclosed. The method for estimating fair value must also be described. As well as the significant components financial statement categories, for instance, the various note payables must be segregated. Loan guarantees. Extensive disclosure required for loan guarantees, including maximum potential future payments, identity of other parties, and collateral, if any. Detailed information that states the liability, maturity date, interest rate, collateral, and any other significant elements must be disclosed. And there's significant disclosure required regarding the various risks associated with liabilities, such as liquidity and market risk. Any issues related to the breach of contract and default on notes payable, and detailed propositions of dealing with these defaults must be disclosed as well. And now I'll pass it off to Amanda.
Thank you. So now that we understand what financial liabilities are, and we understand the accounting policies that are required, the different types of disclosure that we need to include, as well as how it will appear on financial statements, I'll take you through the 4 companies that we chose to analyze, which will be Leon, Rona, Air Canada, and WestJet. We'll be comparing the similarities and differences of Air Canada and WestJet, as they're both in the airline industry, and then we'll also be comparing the similarities of Leon and Rona, as they are both in the home improvement industry. So starting off with WestJet and Air Canada, I want to take it into first the similarities between these 2 companies within the accounting policies. As already stated by Marc, the initial recognition is at fair value for these liabilities, and then the subsequent measure is at the amortized cost using the effective interest rate method. All financial liabilities that are classified as a held for sale or trading are measured at fair value through profit or loss. But however, the loans and receivables, or other financial liabilities, as previously discussed, are measured at amortized cost using the effective interest rate method. This is similar under both WestJet and Air Canada, and both companies extensively disclose this to their viewers. Now, let's look at a few of the differences that I saw that were highlighted within the financial statements. Primarily, WestJet, they have financial liabilities that exclude derivatives. Their derivatives are actually used through cash flow hedging, and then whereas Air Canada includes their derivatives within their financial liabilities. And back to WestJet, they use their qualifying transaction costs of their financial liabilities to offset against the same financial liability. We talked about transaction costs, and this was something that was pulled up in WestJet, but in the disclosure of Air Canada, there wasn't any specific way that was stated. However, Air Canada does have a loan guarantee, which I thought was very interesting to state right now, how the US dollars, 490, and Canadian dollars, 310, and Japanese yen, of 9,677 of aircraft financing is supported by this loan guarantee. And they also stated within their note disclosure the name of the person, as extensive disclosure is required, and the amount that is of a loan guarantee. Now when we look at the financial statement presentation similarities and differences, you'll see that both WestJet and Air Canada all changes in fair value of the fair value through profit or loss financial liabilities, like those held for sale or held for trading, they translate into the statement of profit or loss. And for differences, it was noted that any impairment for WestJet is recorded in net earnings. And at every ending reporting period, assessment of the impairment of other financial liabilities is performed. Another thing to recognize within Air Canada as a difference is that the credit risk of the corporation and the counterparty are taken into consideration in determining the fair value of the financial liabilities. So now, moving on to Rona and Leon. They both have many of the same similarities as previously stated with WestJet and Air Canada, as they're all following the accounting principles that have been described. So that included initial recognition at fair value, subsequent measure at amortized cost, using the effective interest rate method. The financial liabilities there's certain financial liabilities that go through fair value through profit or loss, which are the held for sale or trading. And then loans and receivable and other financial liabilities go to amortized cost through the effective interest rate method. Now, they went into a little more discussion in both companies about derecognition. So that is when it is extinguished, discharged, canceled, or expired, you must derecognize this liability. Also, they both stated that they directly attribute the transaction costs that are added and deducted from the fair value of the financial liability, not recognized through fair value profit or loss. Obviously, the liabilities that go through fair value through profit or loss don't need to recognize any of these gains or losses because it automatically is done continually. And Leon's, for a difference, they stated a fair value hierarchy is used to categorize the inputs used to measure the fair value of financial liabilities. I'm sure all of them do use this method of the fair value hierarchy, though Leon went into further extensive disclosure. And looking back to Leon's and Rona's in terms of their financial statement presentation, much like the other two companies, the change in the fair value through profit or loss financial liabilities translate into the statement of profit or loss. And finally, each company did do extensive disclosure how they recognized the future impacts in 2018 that the mandatory adoption of IFRS 9 will have on their financial instruments and financial statements. Matthew?
So moving on to ASPE policies, so straight line discount amortization. So under ASPE, they have the choice to either adopt a straight line amortization or they can use the effective interest method. So this choice is the difference under policy. And also for derecognition, so extinguishment accounting will be applied when the change in terms is substantial. So this change is considered substantial when the new term differs by at least 10% from the remaining cash flows under the original terms. And this difference in carrying amount of the financial liabilities of extinguishment is considered and is recognized in the net income for this period. And then another policy under ASPE is convertible debt, and this must be treated as a compound financial instrument, but the standard under ASPE allows the company to report equity as either at zero or we're using it under IFRS way, so which effectively makes the convertible debt entirely a liability. So moving on to ASPE financial statement presentation, so the main difference deals with convertible debt, and under convertible bonds, for example, there's not an equity component under ASPE, meaning that there will not be an account such as this equity component in the statement. So therefore, no liability section on the balance sheet, and this issue will be shown in the next section. So then, with respect to ASPE disclosure, so an entity must disclose the interest rate, the description of a liability, the maturity date, the amount outstanding, the carrying amount of the collateral that is secured, the value of this collateral, the amount of the payments that are required within the next 5 years, and with respect to an entity with liability that contains both debt and equity, they shall disclose the conversion option and also the expiry date of the option. So then for the financial restatement, so here we have a convertible debt that has with the Leon's furniture, and the initial carrying value was $100,000, but $9,000 of that was for equity, and the remainder was for debt, and then there was a small portion of accretion. So under ASPE, this equity portion would turn to zero. So if we move on, so we see on the balance sheet how they have on the second line there's 90,000, 952 in debt. So if we move on to the new slide, it'll actually add a 9,000, and it'll be 9841, and then if you go down to the bottom, how there's the equity component, how it turns to zero, so that will effectively change the total liabilities, and the total liabilities and shareholders equity, it won't change.
Awesome, and thank you. So that's our presentation. If you have any questions, please leave them on the YouTube channel.